our annual FSUN meeting, and it's great to see so many of y'all here in the Great Hall, and I know that there's a number of you joining us online. We have a couple of giveaways, and for people who are joining us online, we will be randomly selecting you all online as well. And we're really excited for the agenda we have coming up. And before I forget, my name is An Pham. I'm the chair of the subcommittee for FSUN. I work right here in the East Bend campus, and I'm really happy to welcome you here today. And I don't want to keep this very long, so our very first speaker is Sherry Kutzler, the Director of Accounting Services, and she's going to be talking about fund accounting.
We're up and running, ready to go. So now I got to rethink because Andy kind of stole my first sentence, so I got to think of where I start now. So I'm Sherry Kutzler. I'm the Director of Accounting Services. Probably some of you have seen me up here speak. I would like to thank you very much for inviting us to come today and talk to you. It's kind of interesting as I was working on we frequently get invited to come and talk to people about how do we do things. So how do we go into the system and enter that journal entry? How do we go in and enter a voucher? How do we get in? So this is a nice change to be able to come and actually talk about why we do the things that we do. And it really and truly is not that Central is just waiting and kind of thinking about things to try to torment you. We really do have reasons for why we do what we do. Uh-oh, I'm in trouble. Can everybody hear me okay? Sorry. And so we really do have a reason and restrictions and things like that for why we require certain things. So hopefully once we're done with all the presentations today, you'll have a better feel for why we really do what we do at the university. So with that, we're going to get started. Probably in the event of full disclosure, I should tell you that the people who know me know that I'm a pretty big coffee drinker. And as of this morning, I've had like 4 sips. So if I start slowing down towards the end of the presentation, if somebody could run up with some espresso shots or something, that would be great. That'll keep me going. So let's get started with fund accounting, if I can get it to work. Go. All right. So we hear about fund accounting a lot, and what do we really mean about fund accounting? So let's go through the description first. The definition for fund accounting is used by nonprofit and governmental organizations. It is a method of segregating resources and expenditures into categories, also called funds, according to the funding sources and any restrictions placed on their use by external agencies and donors. Financial resources and expenses are recorded in different fund types. Each fund type has a different purpose and requirements. That's clear as mud, right? Everybody's got that? Perfect. Great. My hour presentation is over. I'm done. Thank you. So unfortunately, it's not quite that easy. So fund accounting is basically, taking all of these words, is basically a way for the university to track the resources that we receive. Frequently, the resources have restrictions on them as far as what we can use the money for. Sometimes they are just funds that we receive that we can use for anything we want. Other times, the donors are very, very specific about what we can use those funds for. So in order to make sure that we're meeting the donor requirements, we use fund accounting. So with fund accounting, you're tracking all of the assets and liabilities and all of the activity related to that particular resource. So why use funds at all? So for those of you that have worked in other organizations other than a nonprofit or governmental, you probably were not exposed to fund accounting and never really had to do it. Corporations and businesses don't use fund accounting. And the reason that we have differences is really around our reporting and what our responsibilities are to our customers and investors. So for corporations are responsible to investors or stockholders to return a profit. So a lot of times you'll hear their financial statements referred to as profit and loss statements. They really focus on how much money do they bring in, how much money goes out the door, and how much money can they return to their stockholders or their investors. They focus very heavily on that profit. Universities are required to report financial activity based on the donor, the state, or other governmental agencies. And as I mentioned earlier, a lot of times those resources have restrictions on them, and we are required to follow those restrictions. So fund accounting basically provides the method for universities to report based on the various requirements, restrictions, limitations, and donors. So we've talked about various sources of revenue. So where does the university's money come from? We know it comes in, but where? So this is not an all-inclusive list, but it is several of the sources that we receive money from. So we receive tuition and fees, students coming in, tuition and fees to the university for their education. We receive grants and contract money, a lot of times for research and different things like that. We get gifts from donors, so memorials, alumni, different people who want to support the university and to help the university with their mission. We have auxiliary and educational activities, which are usually a type of sales. We have investment income, so we'll talk a little bit more later about endowment and investments, but we do have investment income. And then we receive state and federal appropriations. So now we know all about fund accounting. We know what it is, but I guess the bigger question might be, what's a fund? So you know what fund accounting is, but what is a fund? So a fund is defined as a self-balancing separate entity that consists of assets, liabilities, and a fund balance. And like it or not, you guys are going to get exposed to accounting language today. It's just the way it goes. So they are separate accounts maintained in each fund to ensure that the limitations and restrictions placed on the use of specific resources are observed. So what do we mean when we say limitations and restrictions? A lot of times when we receive money, we have restrictions or limitations on how it can be spent. So let's think about a donor that might give us money for scholarships. They specifically want that money to go to scholarships. So what a fund does is it allows us the ability to track those resources that we receive in and make sure that they really are going to scholarships. So some of the examples of funds that the university has, state appropriation and tuition, other unrestricted, auxiliary services, federal work study, National Science Foundation, and joint programs with MNSCU. So that is a very small list of the funds that are on the university's chart of accounts. We actually have about 275 funds within the chart of accounts in order to track the resources. So, went too fast, sorry, nobody saw that screen, right? So we're going to ask a really hard question now. Are you ready? So all of the funds are put into a group. What do you suppose we call that? A fund group. So pretty easy, right? That was not hard. So you will hear us refer a lot of times to fund groups, and a fund group is just that. It's a collection of funds. All of the funds that we talked about earlier, so like auxiliary, tuition, state appropriation, those are all funds that roll into a group. Some of the fund groups that the university uses, they have current funds, loan funds, endowment and investment funds, client funds, and agency funds. There are a few other funds out there if you look at other nonprofit and governmental organizations, but these are the ones that the university uses. So let's walk through each of the funds, what we mean by them, and how they actually kind of operate. So we'll walk through the definition first. So a current fund includes resources that are expendable for the primary and supporting missions of the university. The resources are intended for general operating purposes, and there are categories within current funds. So the subcategories for current funds are unrestricted, So that's where the resources that we receive have no stipulations made by the donor or other external agency related to how we use that money. Restricted is just that. It's exactly what it sounds like. We receive the funds, they're meant for operations, but they are limited by the donors or external agencies to specific uses or specific operations. So an example of a current fund would be state appropriation and tuition. So state appropriation is given to the university through legislative act by the state of Minnesota. It's intended for operating and maintenance expenses. And other than that, we don't have a lot of requirements around where exactly we spend that money. Restricted current funds, an example of that would be the state special agriculture. So again, it's funds that the state has awarded to the university through legislative act, but the state has imposed limitations or restrictions on how we can use those resources. And in this case, it's specifically agriculture related. So loan funds. Loan funds are pretty easy to describe. They're loans. These are funds that we use for students predominantly, and it can be from a variety of sources, federal government, the state, donors, and the university itself. Typically, the way loan funds operate is it's kind of on a revolving basis. So we have funds, we loan those out to students. As they pay back principal and interest, we're then able to loan more money to another student. And so it's kind of a revolving pool of money. An example of a loan fund would be Perkins. So everybody hopefully has heard of Perkins loans, and that would be one of the categories that we would classify into this fund. Endowment and investment funds. So endowment and investment funds are resources that are invested for the purpose of producing revenue and generally have restrictions related to principal or use. There are two categories in endowment and investment funds. There are true endowments, and what true endowments are is we have received money from a donor where the principal cannot be spent. So we invest the principal. We have to retain the principal for perpetuity. We can spend the income that's generated off of that principal and off of that investment, but we can never touch the principal itself. The other type of endowment classification is called quasi-endowment, and in these, both the principal and the income can be spent. It can be used by the departments. It can be used by the Board of Regents. Usually there are probably, in all likelihood, still some donor restrictions applied to those, so we can only use the principal and income for certain things. So again, think of scholarships. We would only be able to use the principal and the interest for scholarships. So this one is just a little bit different from the standpoint that you can spend technically all the money, but we very seldom really do that. So. Plant funds. So plant funds are generally used for one of four purposes. They're acquisition of long-lived assets for institutional purposes, so think of buildings. Renewal and replacement of institutional properties, so when they're remodeling, renovating, maintenance, maintenance is not quite right, but would fall into this category. Debt service charges and retirement of indebtedness and the cost of the long-lived assets. So a lot of times what we see in our plant funds are the bonds and the debt that we have issued that relate to specific capital projects. So if you think of the bonds that were issued to build, let's see, we've done bond issuances for like the Tate renovation. Those would wind up in the plant funds. Agency funds are a little bit of an odd fund. So the easiest way to describe agency funds is the money really and truly doesn't belong to the university. So agency funds are used to record funds held by the university for outside groups who have a close relationship with the university. So we are the custodian or the fiscal officer for those funds, but we don't have any right to spend those funds. We do report the assets and liabilities of those on our balance sheet, but we do not, again, have any authority to spend the money. We are literally just the custodians for those funds. So we go through the process of segregating out all the resources. We track all the expenses. Why do we do that, and what are we using that information for? So as we segregate out these resources, it allows the university to compile accurate financial statements which illustrate how the university meets its mission of instruction, research, and public service. It allows us to monitor resources and expenditures to ensure compliance with donor restrictions or other external agencies. And it provides management with a way to evaluate the data for organizational performance. In addition, it also provides comparable statements with other universities. Most universities that are nonprofits use fund accounting, and so it would allow a student, an investor, different users of the financial statements to compare how the University of Minnesota does compared to other universities. So who are the users of our data? Again, not an all-inclusive list, but these are some of the bigger groups that use it. So parents and students use our data. They look at our annual report. They look at our financial statements. The parents want to know when they're sending their students to the University of Minnesota, is the university responsible with their resources? Are they using the money appropriately? Are they supporting the missions that they say that they have? Rating agencies. So when we go out, which would be Standard & Poor's, Moody's, when we go out to issue debt in order to build a new building or something like that, the rating agencies are using our financial statements to set interest rates, establish other criteria, basically make sure that we're a sound investment for them to loan money to. Investors. So we need somebody to buy those bonds when we issue those for debt. So investors use our financial statements in order to make sure that we're going to pay the money back when we say we will, that we appear to be, for lack of a better word, profitable, even though we don't generate a profit, but that we do have money to repay the funds. The state of Minnesota uses our financial statements for legislative decisions as they're reviewing state appropriations and budgets. They actually incorporate our financial statements into theirs, and so they are also a big user of our statements. Accrediting agencies, so NCAA or NCAA, Higher Learning Commission, they all use our financial statements as well as part of the accreditation process. And finally, donors. So if you're a donor and you want to donate to the University of Minnesota, you want to make sure that the university is sound. You want to make sure that we are putting money behind the mission that we say we are. You want to see where our other resources are coming from and that it's not just donors or loans or something like that. So one of the questions we hear a lot in accounting services and we see a lot are fund transfers. People moving money between all these different funds that we've talked about. So I thought it'd probably be a really good idea to kind of walk through why sometimes your fund transfers are denied. Sometimes you have to get extra approvals in order to do those. And so keeping in mind everything we've walked through, let's talk a little bit about fund transfers. So what is a fund transfer? A fund transfer is basically a resource or cost transfer between or amongst funds. There are some things you need to remember that transfers may occur. Keyword there is may. They do not have to happen, and they may be denied depending on what you're trying to do. So transfers may occur between funds or within a fund. Transfers must always adhere to university policy, donor restrictions, department or college requirements, donor restrictions must always be followed. Fund transfers crossing between restricted and unrestricted should be avoided if possible. And the reason, and we're going to walk through an example to show you why we need to make sure we're not mixing funds like that, is that fund transfers can get lost as they're moved between funds. making it very difficult, if not impossible, to report on the university's accountability for those resources. So let's walk through an example so it's a little bit more clear on what we mean by that. So a donor has decided to give us some money, and they say they want that money to go specifically to basketballs for the athletics department. Nothing else, not footballs, not baseballs, basketballs. So we've put those resources and those funds into a restricted expendable fund. Again, restricted because it's restricted for the use of basketballs, expendable because we can expend it. We can use it to purchase those basketballs. So we went out and we used a little bit of the money and decided that we needed to fund another chart string somewhere that is within unrestricted. Again, remembering that unrestricted means there's no limitations and no restrictions on how we spend that money. So you do a cost transfer or a journal entry in general ledger, and you move some of your money from your restricted expendable account to your unrestricted account. You've now lost, as those funds all get mingled together, you've now lost how much you really had in resource and how much you really spent on those basketballs. So now when a donor comes back and says, so I gave you X number of dollars to purchase basketballs, I'd like to know how many basketballs you purchased, what kind of basketballs they were, how much of my money is left over, and when did you purchase them? You can tell them part of the story. You can't tell them all of it because part of the money is gone because you moved it into another fund that has now been spent. So what that has done now is just through accident, because it just happened, was not intentional, but what we did was we violated the restrictions that the donor put on us. The donor said to use that money for basketballs only, and we really can't tell them that's really what we did. So consequences when we violate restrictions can include things like losing our funding from a donor. So a donor could say, you know, I gave you money, I asked you to purchase basketballs with it, and it looks like you paid for supplies for the FSUN meeting. So we could lose funding from that donor. It can hurt our reputation as word gets out that, geez, you know, you give the University of Minnesota money, yeah, maybe they'll use it for what you asked for and maybe not. So that's why whenever we see in accounting services, we see transactions crossing funds, especially going between restricted expendable and unrestricted, it causes us to ask a lot of questions. There are sometimes very legitimate reasons for why those transactions need to occur, but it should not be the norm. We really should try to avoid those transactions going between those kinds of funds. So now we know everything there is to know about fund accounting, right? Hopefully. We know what a fund is. We know what a fund group is. We know how they're reported. Okay. So we're going to go in. The other part of my presentation was focused around just basic accounting information. Things that we sometimes take for granted in Central and people who have been at the university for a long time. We sometimes just need to step back and say, you know what, maybe we don't really have all of this together yet. So what I mean by that, so I was invited during year end to come and talk to a group, and they wanted me to talk about year end. So when somebody asks me to come and talk about year end, what that always means to me is come and talk to us about what do we need to do, what are the deadlines, when are the systems coming down, when are the systems coming back up. But one of the questions they had for me was, what exactly is year end, and why are we doing it? And I thought, you know, that's a really good question because we never actually focus on that. We always focus on here are all the things you have to do with year end, but we don't really tell you why you're doing it. We just tell you it's year end. Just do it. It's year end. So we're going to walk through why. We're going to walk through a little bit about the fiscal years and kind of go through some of the things that are around year end. So a fiscal year. So a fiscal year is basically just a reporting time frame for an organization. All organizations have reporting time frames. They are generally a year. Some of them are calendar years, so December 30th would be their end date. So their time period would be January 1st to December 31st. Had to stop and think if there were 31 days in December. There are. Had to run through that little poem, you know. And so kind of similar to your own situation. You get the W-2 at the end of the year for January 1st through December 31st. Other organizations like the university have fiscal years. And a fiscal year can be any time frame within the calendar year, and it's always, again, a year, but you can pick your end date if you want. So for the university, our fiscal year end date is June 30th. So our fiscal year runs from July 1st to June 30th. So what that means is that all of the university's financial statements for the year are prepared as of June 30th. So within the fiscal year, we have accounting periods, and there are a lot of them at the university. So more months than I ever knew existed before I came here. So let's walk through a little bit about what all of these periods mean. You see them in your reports sometimes. You go to run a UM report, and it's one of the criteria that you can select. Which periods do you want? It goes all the way up to 915. So let's walk through what each of these mean, what we do with these periods, and how they kind of fall into the whole fiscal year process. So period 0 is used for beginning balances for balance sheet categories. So assets, liabilities, net position. So where the university ends on June 30th of one fiscal year, so let's use fiscal year 17, the balances for assets, liabilities, and net position roll into period 0 to start out fiscal year 18. You can't make transactions into that period. It's a system-generated process when we run carry forward at the end of the year, and then we also run the year-end process, which actually closes out PeopleSoft. It actually makes this entry for us. So it literally closes the year, and it moves all those ending balances into the beginning balance to start the next year. Periods 1 through 12 represent the months within the year. So if you're on a calendar year basis, month 1 is going to be January. If you're on a fiscal year basis, like the university, month 1 is going to be July. Likewise, period 12 is December for calendar year and June for the university. The periods 1 through 12 are used by academic and central departments to record financial transactions in the system. So into PeopleSoft, General Ledger, the disbursements module, purchasing. There are adjusting periods because we have more, like I said, than just the 12. So period 913, so I should tell you, all adjusting periods start with a 9. Anytime you see a period, an accounting period that has a 9 in front of it, that is an adjusting period. So period 913 is used by the academic and central departments during the year-end process only to make adjustments after period 12 has closed. So the purpose of period 913 is we've closed period 12, you've got all your transactions in, you think you're done, you run your reports, and holy cow, you forgot a transaction, or you entered one that you thought was right, but it was backwards. Happens to all of us. Period 913 gives you that option that you can use that then to make those corrections so that you can get your year-end balances correct. There are 5 other adjusting periods, all used by accounting services. So period 914 and 915 are specifically related to year-end. And period 921, 22, and 23 represent quarters 1, 2, and 3 during the fiscal year. What we use these for is to get the university's financial statements accurate and correct, and to put them more into GAAP or accrual-based accounting. We also record a lot of adjustments. We always record adjustments only at the university level, so you should never see an entry in any of these adjusting periods that's hitting your department. 913, yes, because remember, you're making those entries, but 914, 915, 921, 22, and 23, you should never see transactions in there unless there was some kind of an exception. And usually it's when a department has specifically asked us to do that for them, and even then, we're really hesitant to do that. All of our entries in these adjusting periods are put at the university level. So what that means is we record transactions for Twin Cities, Morris, Crookston, Duluth, and Rochester. We have one department for each, and that's where we record all of our adjusting entries. So now you know a little bit about how we do the fiscal year and the accounting periods and what they represent. And we've talked a little bit about the university's financial statements, but let's actually walk through them and take a look at really what are the university's financial statements. Some people have seen those, some people have not. But I think as we walk through them and you start seeing some of the pieces of the financial statements, hopefully it'll help a little bit more on why we are so, I don't want to say we're rigid, accounting services is not rigid, but we are pretty demanding on making sure the accounts are correct, the funds are correct, and making sure that the chart string that you're using is appropriate. So let's walk through these a little bit. So every year the university creates an annual report. We do it after year end. Accounting services right now is actually working on that. Once the departments are out of the system, so 9/13 closes, is actually when we start. So we're working on the annual report from about the middle of July until the end of October. The annual report is audited by external auditors who will be here tomorrow, and they will be here from tomorrow until the end of October. And so they go through everything with kind of a fine-tooth comb, looking at everything that we have, making sure that the transactions we're doing are appropriate, that we have everything appropriately coded, and that the reports are fairly represented. So within the annual report, there are three primary financial statements. There's the statement of net position, or if you've been at other places other than the U, it's called the balance sheet. There is the statement of revenues, expenses, and changes in net position. Easier way to term that is an income statement. And there's the statement of cash flows, which is just cash flows. So let's look at each one of these and kind of walk through a little bit about each of the statements. Got to get on the right page here. There we go. All right, so the statement of net position, also called the balance sheet. The balance sheet reports the university's assets, liabilities, and net position. For some of you that have been around the U for a while, that used to be called net assets. So it was assets, liabilities, and net assets, which is the balance. About 3 or 4 years ago, I think, GASB, which is the Governmental Accounting Standards Board, decided to change the terminology to net position. And so we no longer have net assets, we have net position. So assets, let's walk through each of the categories that are on there. So assets are something that the university owns that is expected to provide a benefit in the future. So when you think of assets, think of things that we can use to help with the mission, help with some of our other ongoing activities that we have. So cash, that's a great asset. Capital assets, so our buildings, our capital equipment, our infrastructure. Those are all things that are assets to the university because we can use them to help benefit the university. The second part of the statement of net position or balance sheet are liabilities. And liabilities are claims on the university's resources. So when you think of claims on the resources, it's things we owe, things we have to pay for. So accounts payable, so you go out and you buy supplies. We have to record that invoice, we have to make that payment, and that's using some of our cash, which is our asset or our resource. Long-term debt, again, remembering that we issue bonds for long-term debt in order to build things and do different things with that money, but we have to pay it back. It's not free money. And so that's considered a liability because, again, it's using our resources, it's using our cash to make those payments. Both assets and liabilities are divided into current and non-current. Current assets and liabilities are things that are expected to be used up within the year. So if you think, again, about cash, usually you bring cash in and you spend it. So it's expected to be used up. If you think of, for assets, if you think of the building we're sitting in right now for Kaufman, that's a long-term asset. We're not going to use this in a year. It's still going to be sitting here decades from now. So that would fall under non-current assets. Likewise, we have the same thing for liabilities. Invoices that are expected to be paid in 30 days would be considered a current liability. Our long-term debt that might take us years to pay off would be considered a non-current liability. So now we're going to get to the one that's a little trickier. Those hopefully were pretty easy. So now we have net position. Remember, this used to be called net assets. So the net position really represents the wealth of the university. How you get to net positions when you're calculating, it's essentially assets minus liabilities. That gives us our net position. So if we have more money coming in than more money going out, then we have a net position that's positive. There are 4 categories within net position. We have unrestricted, and these are going to match up very similar to the funds. So as we're going through these, think about the funds that we've already walked through. So unrestricted net assets or net position, sorry, it's only been 3 or 4 years, but I still use that term. Unrestricted means that those funds can be used for pretty much what we want to use them for. There aren't any restrictions on their use. So nobody has said you have to use it for purchasing those basketballs. Restricted expendable is just that. Just like the fund name, it's money that can be spent, but it's restricted on how we spend it. Restricted non-expendable, so when you're thinking of that, think of those endowments we talked about, where we have the true endowments that we can't spend the principal. That would fall under restricted non-expendable. And finally, invested in capital assets. And again, that's our buildings, our capital equipment, our infrastructure, and when we're reporting invested in capital assets, we're also netting that and reducing that balance by the amount of debt that's associated to those items. So for example, when TCF Stadium was built, we had bonds taken out for that. When we recorded TCF Stadium, we would have offset the value of that building against the debt that was still outstanding. Hopefully that makes sense. Let's see. So when we talk about net position, remember I said that represents the wealth of the university. So not all money is easily spent or can be spent the same. So remember we talked about unrestricted, no limitations, no restrictions, we can spend that how we want. We have restricted expendable with those limitations and restrictions, and of course non-expendable. So another way to look at these different categories is a concept, or it's been defined as the color of money. And it really puts colors around kind of those categories on the net position. A lot of times people look at the university's balance sheet, and we're going to look at that in just a moment, and they see that bottom line and they say, wow, the university's got a lot of money. Why aren't they spending it? Well, these categories don't let us spend that. And so one of the things they do is, another way to look at it is saying that unrestricted funds are green. Green can be spent. Restricted expendable are yellow, and restricted non-expendable are red. And so that's just something to kind of leave you with. We have a guest speaker coming in over the lunch hour, Mike Bolna, and he's actually going to be going through the color of money concepts a little bit more and a little bit more in depth. So I don't want to steal his thunder because he knows where I live. So we're going to just stop right there with that one. So we're going to go through Chartfield values, and then we're going to connect all the dots, and we're going to look at the financial statements so that we can hopefully see how everything kind of flowed, everything that you're doing in the system flows through all the way to the financial statements. So we have the predominant Chartfield values. I did leave off the CS value and the analysis type and things like that. So we have fund, depth ID, program, project, Chartfield 1, 2, 3, and account. So let's talk about each one, what they are, what they represent, and then we'll talk a little bit more about how they show up on the statements. So we've already talked about a fund, right? We all know what a fund is now, right? Nodding, yes? Good? Yay. So a depth ID. A depth ID identifies the unit responsible for the financial activity. So when you think about your own depth ID that you're using, all your transactions are going in and out. It's a way for managers to see, and the university to see how certain areas are performing. Are they doing well, not well, do they need help? A program is an alphanumeric character that describes the nature of the activity. So think about the things that we do at the university: research, academic support, instruction, public service. And a program helps us define that. We'll talk a little bit more about function, which is associated with program, in a little bit. Terry's actually going to talk to you about that when I'm done with this presentation. Project identifies sponsored projects and select non-sponsored transactions. So what does that mean? Select non-sponsored transactions. Usually that's capital planning and project management uses that to track their buildings and their projects that they are doing that expand over a long period of time so that they can capture the costs in that. And then we have Chartfield 1, 2, and FinMAC ID, and those are optional values used by various departments, again, to help track those resources at a department level so that you can see where your money is going or where your resources are coming from. And finally, we have account. So the account is a 6-digit number that identifies the nature of the transaction. So again, thinking about some of the categories we walked through, assets, liabilities, revenues, expenses. The account actually uses smart coding. So when PeopleSoft was implemented, they elected to use smart coding just to make it a little bit easier to help identify those accounts. So with smart coding, the first digit of the account number represents the category that it falls into. So any account that you ever see that has a 1 and starts with a 1 is an asset. 2 is liabilities. 3 is net position. 4 and 5 are revenues. 6 are transfers. 7 and 8 are expenses. And 9 are statistical accounts. So that's where your carry forward balances sit. Is they sit in the accounts that start with a 9. So as you're doing your work and you're doing your Chartfield string, and for those of you that have sent a journal entry through and it's sent through to accounting services and we rejected it and denied it and said you need to fix the ID, program, project, account, whatever the case may be, you're probably asking yourself, why does it matter? Getting it into the general ledger, why does it matter? The account determines which category the transaction is reported in the university's financial statements. So if you take a transaction that really should be a revenue and you record it as an asset, that's a very different reporting for the university, and it has a very different meaning. So we watch that really closely. Within each category, so we hear that sometimes too, well, I got it into expenses. Why do you care which expense account I hit? Because we really do report by those various expense accounts as well. So within each category, the account determines the type of activity. So within expenses, so you've picked an account that starts with a 7, but within that you have salaries, supplies, travel expenses, meals perhaps, fringe benefits. There are a whole host of things within that expense category. We do get questions about reporting on those categories. So what was the university's travel expenses incurred for fiscal year 17? How much did the university pay in salaries in fiscal year 17? And so if we're kind of willy-nilly recording these transactions in any account, it makes it really difficult for us to tell the used story in an accurate way and to make sure we're giving people the correct information. So now we've talked about the Chartfield strings, we've talked about funds, we've talked about year-end, and fiscal years. So let's actually take a look. Can you see that? Okay, good, because on my screen it's really small. Let's take a look at the balance sheet. So again, this is the statement of net position. This is what is compiled every year for the university. We actually do financial statement reporting like this twice a year. So we do the big annual report at the end of the year as of June 30th, and again, that's the one that it has notes in it, it has our significant accounting policies. The document is about 100 pages. I'm trying really hard to shrink it down, but GASB keeps wanting to increase it. So, and so it's about a 100-page document that we create, and it is heavily audited, as I mentioned before, and we only, thank goodness, do it once a year. At December 31st for Q2 reporting, we produce these financial statements again, but it's the 3 financial statements. It's the balance sheet, the income statement, and cash flows. We don't do the entire annual report. So looking at the balance sheet, at the very top, you see that we have assets. And remember, we talked about those being broken down into current and non-current. And so we have cash as a current asset, And if you look down towards the bottom of the asset section, you'll see capital assets as our non-current assets. We're going to skip the line that says deferred outflows and come back to that one. Liabilities is our next section. And again, it's broken down between current and non-current. Accounts payable would represent our current activity, or our current liabilities, I'm sorry. And non-current liabilities would be things like our long-term debt, like our bonds that we've issued. We're going to skip deferred inflows for just a minute, and we're going to look at net position. So you can see under net position, we have the 4 categories we've talked about. And this is exactly how we report to everybody. So investors, the state, all those users that we have listed earlier on the screen, this is what they see. This is what they're looking at. And so you can see our unrestricted, you see restricted expendable, restricted non-expendable, and then our net investment in capital assets. And if you can see the number, hopefully you can see that down there. The university, remember, net position represents the wealth of the university. The university's net position for fiscal year 17 was $3.3 billion. But not all that money can be spent. Remember, we have a lot of endowments. If you look at our net investment in capital assets, that's $1.6 billion of that balance. And so we can't actually spend our building. We can't get any money off of it. So those are assets that while they show up as part of the wealth of the university, it's not actually funds that can be spent. So now let's look at the income statement. A little bit different, but similar. So the income statement reports our revenues, our expenses, and then the changes in net position, which is just how we did for the year. It's our performance. Did we do better or worse than, not expected, I'm sorry. Were our revenues higher than our expenses? I'm trying to avoid using that profit word. So Sue keeps telling me I can't refer to corporations anymore because I've been here long enough, but you know, it's a hard habit to break. So at the top, we have our revenues. Operating revenues are things that specifically relate directly to the university and its mission. And so we have student tuition and fees. You can see non-governmental grants and contracts. There's a variety of sources right there. Underneath revenues are expenses. And you can see there that we report the expenses by function. That's part of just nonprofit and governmental accounting. If you look at a corporation's, and yes, I can still refer to that. If you look at a corporation's income statement, what you would see are things like salaries, travel expenses, supplies, different things like that, utilities. For us, we report by function. So we, again, are looking more back towards the mission and the purpose of the university. So we report by instruction, public service, mission, academic support, student services, institutional support, operation and maintenance of plant, scholarships and fellowships, and depreciation. And so as you're choosing those program values for your chart string, this is where that function really plays in, is it shows up here on these financial statements. So when you pick a program value that has institutional support on it, it's going to show up in that line, even though maybe it really belonged in instruction. And so that's why we focus very heavily on the Chartfield values that you're selecting and making sure that they are appropriate for your activity. We don't ever want to tell you you can't do something. We just want to help you get it correct so that it shows up on the financial statements correctly. How am I doing on time? Oh, I'm moving right along. So, encumbrances. Again, something unique for universities, nonprofits, and governmental organizations. Encumbrances are used to reflect future commitments. So if you are looking at your reports and you see actual expenses that have occurred, so you paid everybody in your department, their salary was posted to the general ledger, and it shows up on the reports as actual expenses. But in the meantime, you've gone out and you've issued POs for some supplies. Maybe you have a PO out there for a big travel expense or a big meeting coming up. Without having the encumbrances available, you wouldn't know that those have already been committed. We're a big organization. a lot of people making a lot of transactions, and so for management and other university departments, anybody who uses our statements, mostly internal in this case, having the encumbrances there helps prevent overspending. So let's walk through just an example of how an encumbrance is created and then how it's also released in the system. So first off, for those of you that use UM reports, if you look at the UM reports, you will see columns that will say budget amount. You will have a column that says actuals, encumbrances, actuals plus encumbrances, and then your remaining balance, okay? And that is showing you what's been spent, what's been committed, and then how much you have left over. So an encumbrance is created once the commitment is made. So you go out and you enter a purchase order for supplies. Once that purchase order has been approved and starts routing through the system, it's sent to the vendor so that you can get your supplies. It also creates an encumbrance at that time. And so it's basically saying this money's already been spent. You don't have the product yet, and you don't have the invoice to have cashed or cut the check for it, but the money has been spent because you've already made that commitment. So you get your supplies in, the invoice comes in the door, you enter the invoice into PeopleSoft and you voucher it. Once that invoice is vouchered, it records the actual expense to your actuals column in the general ledger. It records the liability to accounts payable so that the university can pay it, and it releases that encumbrance. Because now that encumbrance is moved from a committed expense to an actual expense because you've actually paid it. Kind of make sense? So our next topic, we're going to talk about function a little bit more. So as you remember, we went through the various Chartfield values, and we talked about program, and we talked about it being an alphanumeric number. And we showed you the function on the income statement, but how did that get there? So Terry's going to talk to you a little bit about how that function actually shows up on those program values, how they roll through the system, and what happens with those. So I hope that you learned a little bit about fund accounting, a little bit more about the funds, hopefully a little bit more about just some general basic accounting things that go on at the university. And the next time accounting services calls and says, you know, you guys, it's the wrong department, wrong account, wrong fund, you'll have a little bit better understanding for why we're doing that. So thank you very much.